Have you ever wondered why your trades get stopped out right before the market goes exactly where you predicted? It's not bad luck, it's not a broken strategy, it's manipulation. In this video, I'm going to reveal the exact candlestick patterns banks and smart money use to trap retail traders. Patterns that look like golden opportunity. Let's break down the traps one by one. Let's start with the first manipulation candlestick pattern, the trap reversal. The trap reversal pattern forms when the market breaks out of an inside bar setup, but then quickly snaps back in the opposite direction. It tricks traders into thinking a breakout is underway, only to reverse and trap them on the wrong side of the move. What makes the trap reversal so powerful isn't just the pattern itself, it's the story behind it. When you spot one on the chart, it usually means that big players, banks, hedge funds, and smart money have just pulled a move. There are two main scenarios. They've deliberately triggered retail stop losses, creating a liquidity vacuum before snapping the price back the other way. Or they're reacting to a sudden market event, causing a sharp reversal right after a fake breakout. Either way, the trap reversal sends a strong message: the initial breakout was a lie, and price is now likely to continue in the opposite direction. So, if price fakes out to the upside from an inside bar and then slams back down, you've got a bearish trap reversal and a high probability move to the downside. Let's break down the anatomy of the trap reversal pattern. It's made up of two key candlesticks. First, an inside bar. This shows market indecision and usually signals a potential breakout. Then comes the pin bar, and this is where the trap is set. In a bearish trap reversal, you'll see an inside bar followed by a bearish pin bar that fakes a breakout to the upside, then slams back down. In a bullish trap reversal, it's the opposite. An inside bar followed by a bullish pin bar that fakes a move lower, then quickly reverses to the upside. This combination creates the illusion of a breakout before flipping and trapping traders who took the bait. You can trade the trap reversal in almost any market condition, except in a choppy market. That's the one environment we avoid completely. But in a trending market, a range-bound market, or even against the trend, as long as it forms at a key support or resistance level, the trap reversal becomes a high probability setup. It gives you a clean entry and a logical stop-loss placement. Here's a real chart example. The market makes a strong move upward and hits a resistance level, then reverses. After a brief pullback, it pushes back up again. But this time, as it reaches that same resistance level, it forms a trap reversal pattern. This isn't just any setup, it's a clear sign that smart money is using that level to trap breakout buyers, then reverse the market back down. Now, look at this chart example. The market hits a key support level and bounces. Then it pulls back again and retests that same support. But this time, something interesting happens. A trap reversal pattern forms. An inside bar followed by a false breakout. It looks like the market is breaking lower, but it's actually a smart money play to trap sellers. Retail traders jump in thinking the breakdown is real, but they've walked right into the trap. What happens next? The market launches upward just as expected, driven by smart money after collecting liquidity. Let's talk about one of the most deceptive tools smart money uses: candles with big wicks. These aren't just random price movements. They're calculated traps. Big wicks show that price moved aggressively in one direction, but couldn't hold. That long wick is a clear sign of rejection. It tells you the market didn't accept that price, and that's not by accident. Smart money, banks, and hedge funds use these moves to trigger retail stop losses or activate breakout orders. They know where retail traders place their stops and where breakout traders wait to enter. So they push price into those zones, trigger the orders, collect liquidity, and reverse. The wick you see is the aftermath of that manipulation. It works because most traders react emotionally to price movement. They chase breakouts, jump in late, or panic when price spikes. But that spike was never meant to last. It was designed to bait retail traders into bad positions. Breakout traders enter thinking a new trend is starting. At the same time, traders with stop losses just beyond key levels get taken out. Once enough liquidity is gathered, price snaps back, leaving both groups trapped. The candle closes far from the wick's extreme, showing strong rejection. Those who entered on the breakout are stuck in losing trades. Those who got stopped out are left frustrated. This whole move was engineered. It's not random. So how do you protect yourself and profit from this? First, don't trade just because price pushes past a key level. Wait for the candle to close. If it closes near its open with a big wick, that's rejection, not confirmation. Second, big wicks usually form at major levels. If you see one at support or resistance, it's a red flag. It means smart money is hunting liquidity, not looking to break out. That's your cue. Consider trading in the opposite direction. Also, pay attention during consolidation. That's when big players accumulate positions. They use wicks to fake breakouts and mislead traders. Once their positions are filled, they'll move the market in the real direction, leaving behind a trail of false signals. The longer the wick, the stronger the manipulation. A massive wick means they pushed price hard, only to reverse it fast. That's a clear trap. Shorter wicks may just signal indecision or weak momentum. But if you see multiple long wicks at the same level, that's your signal. Smart money is testing that zone, triggering orders, but price keeps getting rejected. That's a strong clue the market's about to move in the opposite direction, and when you see it, that's your opportunity. Let's talk about another smart money trick: large candles forming during a sideways market. These big candles might look like the start of a breakout, but often they're traps. When price is moving sideways, the market is in a phase of indecision or accumulation. Price is bouncing between support and resistance. It's not trending, it's building pressure. Smart money loves these moments. It gives them time to build positions, but they need liquidity. And that's where the large candles come in. Here's what happens. Big players suddenly push price hard in one direction. That giant candle creates excitement, it screams momentum, retail traders see it and react emotionally. They jump in, fearing they'll miss a big move. That's exactly what the big players want: more liquidity on the other side. The large candle becomes a trap. It looks like a breakout, but it's just a trick to get traders in. Price might even break out of the range, but then quickly snaps back inside. Classic liquidity grab. Why? Because breakout traders place entries just beyond the range, and stop-loss orders sit there too. By triggering both, smart money fills their orders without moving the market too much. It's emotional manipulation. Big candles create FOMO. They pressure traders to enter without confirmation, a mistake many of us have made, myself included. So how do you protect yourself? Volume is your filter. If a large candle forms on high volume but price quickly reverses, that's a strong sign it was a trap. Smart money used the volume spike to grab liquidity. If it forms on low volume, it might signal weak conviction, and the breakout probably won't last. Let's break down one of the most aggressive forms of candlestick manipulation, the gap trap pattern. It's a setup designed to mislead traders at the exact moment the market opens, especially during the New York session. Here's how it works. A bullish gap trap happens after a downtrend. The market opens with a gap down, convincing traders the drop will continue, but instead of falling further, price snaps back hard and launches upward, forming a strong bullish candle. A bearish gap trap is the opposite. After an uptrend, the market opens with a gap up, pulling in breakout buyers, only to reverse sharply and collapse, forming a strong bearish candle. At first glance, it looks like a sudden shift in market sentiment, but most of the time, that shift is not organic. It's manufactured by smart money to create liquidity. Here's the trap. Retail traders react emotionally to the gap. In a bearish gap trap, long traders believe the move will continue. Meanwhile, breakout buyers enter after the gap up. But as soon as price reverses, both groups are trapped. Their stop losses, conveniently sitting just beyond support or resistance, get triggered. And that's where smart money steps in, using the flood of liquidity to open their own positions. The gap is psychological. It tricks traders into thinking the current trend will continue, but when price violently moves the other way, confusion takes over. Traders panic. Some close their positions at a loss, others reverse their trades, and that emotional reaction is exactly what big players want. The first part of the manipulation is the gap, engineered to provoke action. The second part is the reversal, designed to trap and exploit. Once the reversal starts, stop losses get swept, and that liquidity becomes fuel for the real move. To the trained eye, this trap becomes an opportunity. So, how do you trade the gap trap? Let's say you spot a bearish gap trap. The market gaps up, but then quickly rolls over and reverses. That's your cue to go short. You place your entry at the close of the reversal candle, the one that forms right after the gap move fails. Your stop loss goes just above that candle's high, and your target is the next key support level. Now look at what happened next. The market reversed cleanly, hit the first target, and kept dropping even further. That's the power of trading with smart money. If you spot a bullish gap trap that gaps down, then reverses strongly, you can look for a long entry, expecting continuation higher. The key is to avoid reacting emotionally to the gap. Instead, wait for the trap to spring and then trade in the opposite direction. Let's break down one of the most overlooked manipulation patterns in the market, the power doji. At first glance, it looks harmless, a small-bodied candle with long wicks on both sides. But beneath the surface, this candle tells a bigger story. The small body means price opened and closed near the same level, no real progress in either direction, but the long wicks show that both buyers and sellers tried to take control and failed. It's a clear sign of indecision, and more importantly, a setup for manipulation. Okay, power dojis often show up at major turning points in the market. They usually appear after a strong trend, right when it seems like the market is pausing before its next move. But smart money doesn't pause. They use this moment to set a trap. Here's how it works. Most beginner traders are taught that a power doji signals a potential breakout. So what do? They place buy stop orders above the high, expecting the market to explode upward. And smart money knows it. So they push the price just above the high, triggering all those buy orders, and then slam it right back down. The result? Retail traders are instantly trapped in losing positions, while smart money collects the liquidity they need to enter their real trades. Now let's flip the scenario. The market is in a strong downtrend and a power doji forms near the bottom of a move. Some traders see it as a potential reversal signal and place buy stop orders above the doji's high, hoping to catch the beginning of a new uptrend if price turns around. At the same time, others expect the downtrend to continue and place sell orders below the low, anticipating a breakdown. Smart money knows this, so what do? They push price slightly higher first, just enough to trigger the buy stops of the traders trying to catch the reversal. Then, they slam price down below the doji's low to activate the breakout sellers. With both sides now trapped and liquidity collected, the market snaps back up with force. The short sellers panic, start closing their losing trades, and that panic adds fuel to the reversal, while smart money profits from the move they engineered. Let's dive into a brutal manipulation pattern that wipes out tons of retail traders every week, the fake pin bar trap. Now, here's what you need to know first. Banks and institutions know exactly how retail traders think. They know the books you've read, they know you're watching for pin bars, and they use that knowledge against you. Pin bars are one of the most popular candlestick signals. They show rejection, they look clean, and they're easy to spot. But here's the trap. Let's say the market is in a strong uptrend and suddenly a big bearish pin bar candle forms. Retail traders see that and think, that's it, the trend is over, time to short. So they enter their sell trades. But what happens next? The market forms a bullish candle, wipes out their stop losses, and continues the uptrend like nothing happened. Now flip the situation. The market is in a strong downtrend and out of nowhere you see a clean bullish pin bar. Retail traders jump in, thinking it's the end of the trend and the beginning of a reversal. Then a bearish candle slams down, hits their stops, and the trend keeps going. That right there is what we call a fake pin bar trap. Banks use this trap to lure traders into early reversals, trigger stop losses sitting just above or below key pin bar levels, and create liquidity for their real trades. It's not about the candle, it's about the context. And that's how you avoid this trap, by understanding trend structure. Here's the golden rule. A pin bar outside of trend structure is a trap waiting to happen. Let's break this down with a real example. An uptrend has two phases. Impulsive moves, where price breaks higher and moves with strength. Retracement moves, where price pulls back as traders take profits. The impulsive moves are where banks enter. That's why price shoots up. The retracement is where they take profits, and where you see temporary pullbacks. Now, here's where most traders go wrong. They see a bearish pin bar forming during an impulsive leg, and they think it's a reversal, but that's just smart money offloading some profits before pushing price higher again. The only time a bullish pin bar becomes high probability in an uptrend is when it forms after a retracement and ideally on a newly formed support, like a broken resistance turn support. Let's look at this example. The market is trending up, price breaks through resistance, impulsive move. It pulls back to retest that level, retracement. A bullish pin bar forms at that exact spot. That's where the pin bar becomes powerful. Why? Because now it's aligned with market structure, trend direction, institutional flow. Anywhere else, and it's likely a trap. Now, in a downtrend, same concept reversed. A downtrend has impulsive moves down, driven by smart money selling, retracements up, temporary pullbacks as price breathes. Let's say price breaks through a key support level. It pulls back and forms a bearish pin bar at the new resistance level. That's your high probability signal, not the random bullish pin bar you saw earlier when price was aggressively falling. The fake pin bar in that case was a trap designed to suck in buyers and give banks the liquidity they need to keep shorting. What should you do? Use this pin bar checklist. First, is the market trending? If it is trending, ask yourself, is this an impulsive move or just a pullback? Alright? Next, is the pin bar forming at a key level? And finally, is it in the same direction as smart money? If the answer is yes, then it's a valid trade. If not, step back, because you might be staring at a beautifully painted trap. Now you know how smart money uses candlesticks to trap traders. These patterns aren't signals, they're setups. And now you can trade with the banks, not against them.